You want to invest, but keeping an eye on the market every day isn't your thing. Watching the market go up and down makes you anxious, and you'd rather not spend hours researching the best investment opportunities. Sounds familiar? Then dollar cost averaging might be just what you need. Dollar cost averaging is a strategy where you invest a fixed amount of money at regular intervals, regardless of what the market is doing. This way, you're not trying to time the market, you're just consistently investing over time. Why is this awesome? Well, it's perfect if you can't afford to throw hundreds or thousands of dollars into the stock market at once. You can start small even with just $5. In this video, we're going to show you how you can use dollar cost averaging to be rich and potentially become a millionaire. It's a straightforward approach that can help you build wealth without the stress of constantly monitoring the market. So, ready to dive in? But if you're new to our channel, don't forget to subscribe and hit the bell icon so you won't miss out on the valuable insights we share in our future videos. Alright, let's first understand what dollar cost averaging is all about. What is dollar cost averaging and how it works? So you've probably wondered, can investing make me rich? The answer is yes, but it depends on the strategy you use. One of the best strategies to build long-term wealth is dollar cost averaging. Dollar cost averaging is a simple and automatic investing strategy. It lets you take advantage of the market's ups and downs without the need to time the market perfectly. You invest a fixed amount of money at regular intervals, like monthly or even daily, depending on what you're comfortable with and how much you can invest. This approach spreads out your investments over time, reducing the risk of investing a large amount all at once when the market might be high. The beauty of dollar cost averaging is that it's automatic. You don't have to constantly monitor the market or make frequent investment decisions. This means you can focus on other important things in your life, like your family and your job. For example, if you're investing in your workplace retirement plan, the process is often completely automated. You set it up once, and then your contributions are invested regularly without you having to think about it. By consistently investing the same amount, you'll end up buying more shares when prices are low and fewer shares when prices are high. Over time, this can lead to a lower average cost per share, which is the key advantage of this strategy. When it comes to investing in the stock market, people are often driven by emotions, which can lead to poor decisions. Many tend to buy when stock prices are at their peak and sell when prices are at their lowest. This is where dollar cost averaging shines. Dollar cost averaging removes the emotional aspect of investing by automating the process. You invest a fixed amount of money into a predetermined stock or bond at regular intervals, regardless of the market's condition. For example, let's say you decide to invest $1,000 on the first of each month into a mutual fund called XYZ, starting in January. The price of this fund will fluctuate each month. In January, the price per share is $20. In February, it drops to $1.16. In March, it's $1.12. In April, it goes up to $1.17. And in May, it climbs to $1.23. Each month, you continue to invest $1,000 into this fund. In January, your $1,000 buys you 50 shares. In February, the lower price means you get 62.5 shares. In March, your $1,000 buys even more shares, 83.3. In April, you get 58.2 shares. And in May, the higher price buys you 43.48 shares. After 5 months, you have invested a total of $5,000 and now own 298.14 shares of the mutual fund. Because of the varying prices, your average price per share is $16.77. With the current price of the shares, your investment of $5,000 has grown to $6,857.11. If you had invested the entire $5,000 at once, your returns might have been higher or lower, depending on the market's timing. But by spreading your investments over time, you've reduced your risk and achieved a favorable average price per share. Dollar cost averaging is a less risky way to invest and can help you steadily build wealth over time. Next, let's look at how you can set up dollar cost averaging for your investments. Set up dollar cost averaging for your investments. There are 2 ways to set up dollar cost averaging: manually and automatically. If you choose to do it manually, pick a regular date, like monthly or bi-weekly, and then go to your broker to buy the stock or fund. Repeat this process on each scheduled date. If you prefer the automatic route, it takes a bit more time to set up initially, but it's much easier in the long run. Plus, it makes it easier to continue investing even when the market is down, since you don't have to take any action. Setting up automatic buying might seem like a hassle, but it's actually quite simple. Almost any broker can help you set up an automatic buying plan. Here's how to make dollar cost averaging fully automatic. First, choose your investment. Decide whether you want to buy individual stocks, exchange-traded funds, ETFs, or mutual funds. Individual stocks can fluctuate significantly, and it might be challenging to find a brokerage that allows automatic stock purchases. On the other hand, funds usually fluctuate less and are more diversified, which means you won't be as affected if any single stock in the fund drops significantly. Many less experienced investors prefer funds, and some of the most diversified ones are based on the Standard & Poor's 500 index, which includes companies from all major industries. Once you decide, note the ticker symbol for the stock or fund, which is the shorthand code used for trading. Next, contact your broker to see if they allow automatic purchase plans for your chosen investment. If your broker only supports automatic plans for mutual funds, you might consider opening another brokerage account that meets your needs. There are benefits to having multiple brokerage accounts, such as gaining access to different features and options. Determine how much you can invest regularly. Figure out an amount you can invest without needing to touch it for at least 3 to 5 years. This allows your investment to grow and recover from any short-term price fluctuations. Review your monthly budget to see how much you can comfortably invest after setting aside an emergency fund. Even if you start small, the key is to begin investing regularly. Setting up dollar cost averaging is now more affordable than ever, as major brokers charge no commissions on stock and ETF trades, and many top brokers for mutual funds waive fees for numerous funds. This means you can start with any amount and begin building your investment portfolio. Finally, schedule your automatic plan. Set up the automatic trading plan with your broker using the ticker symbol, the amount you want to invest regularly, and how often you want the trades to occur. The process varies by broker, but the basics remain the same. If you have any questions, your broker can assist you. Apart from that, if your stock or fund pays dividends, consider setting up automatic dividend reinvestment. This means any cash dividend will be used to purchase additional shares, often including fractional shares, maximizing the value of your dividend. This way, your dividends will start earning dividends, further growing your investment. By following these steps, you can easily implement dollar cost averaging and steadily build your wealth over time. Next, let's explore how you can become a millionaire with the dollar cost averaging strategy. How you can become a millionaire with the dollar cost averaging strategy. When we say anyone can become a millionaire, we truly mean it. The first step to achieving millionaire status is to break down the big goal into smaller, actionable steps. Think about this. Would you rather focus on saving $152,820 over 45 years to become a millionaire by 65? Or would you prefer saving $9.43 per day to reach the same goal? The second option sounds much more manageable and less stressful, right? By understanding how much you need to save daily, instead of looking at the big picture all at once, reaching your goal becomes much easier. Let's see how dollar cost averaging can help you achieve this over time. Imagine starting at age 20 with a goal to invest for 45 years. You begin with a portfolio value of $0 and aim for a projected return on investment of 7%. By investing $250 bi-weekly, your portfolio could grow to over $1 million by the time you're 65. While you won't become a millionaire overnight, you will start seeing progress over time. This steady and consistent approach helps you build wealth gradually and reach your financial goals without the stress of trying to time the market. Now that you know everything about dollar cost averaging, it's important to understand that there are also some disadvantages to this strategy. Let's talk about them in detail. Disadvantage of dollar cost averaging. The main disadvantage of dollar cost averaging is that in a market that generally rises over time, you might be better off being fully invested as soon as possible. For example, if you had a lump sum of money to invest during a period of sustained market growth, investing it all at once could result in higher returns compared to spreading it out over time. However, because most people save and invest as they earn money, they don't usually have large sums ready to invest immediately. This is where dollar cost averaging becomes a practical and effective option. allowing you to invest small amounts regularly without trying to time the market. Another downside is that you still need to choose good investments. If you're using dollar cost averaging to invest in a poor performing asset, the method of your investment won't save you from potential losses. For instance, if you consistently invest in a stock or fund that declines steadily over time, you could end up with significant losses regardless of your dollar cost averaging strategy. This approach works best with broad-based funds, like an S&P 500 index fund, which has shown strong performance over long periods. By investing in diversified funds, you spread out your risk across many companies and industries, increasing your chances of benefiting from the market's overall growth. Additionally, dollar cost averaging might result in higher transaction fees if you're not using a commission-free broker. Frequent purchases can add up in terms of fees, which might eat into your investment returns. It's crucial to choose a broker that offers low or no commissions on trades to maximize the effectiveness of your dollar cost averaging strategy. Understanding these drawbacks is very crucial for making informed investment decisions and maximizing the benefits of dollar cost averaging. By being aware of the potential pitfalls, you can take steps to mitigate them and ensure that your investment strategy aligns with your financial goals. To sum up the whole discussion, dollar cost averaging is a simple way to help reduce your risk and increase your returns, especially in a volatile stock market. By setting up your brokerage account to buy stocks or funds automatically and regularly, you can focus on doing the things you love instead of spending all your time managing investments. Often in investing, you can get better results with less effort by using this consistent and automatic approach. And that's how dollar cost averaging can help you build significant wealth over time. If you found this video helpful, make sure to hit the subscribe button and ring the bell so you don't miss out on any of our future videos. Thank you for watching, and we'll see you in the next one.